Okay, so without further ado, I'm delighted to be chairing this event, today's event on pension funds and market tumult. This is one of our seminars for the Open University Economics Seminar Series. I'm Christina Vascarizis, a lecturer in the department. Before I move on to introducing our distinguished guests, just a little bit about our theme. I don't know how many pension experts are out there, but I certainly feel like this is a topic that, for those of us who are just only marginally watching on the margins, what's happening in pension world, we all sort of deserve to know a little bit more about the largest pool of wealth in Europe currently held in pension funds that seem to be sort of the source of lots of financial instabilities that we've seen in recent years. So before I introduce our speakers, just to say a tiny bit about our seminar, the OU Economics has launched a seminar series over the last couple of years that really tries to bring academics together to exchange and sort of share in dialogue with policymakers, practitioners, and non-academic experts from industry, from trade unions, members of the public, who work across a range of topics. So we often examined ranges of issues: cost of living, inequality. Privatization is our next event coming up at the end of June. I'll put details of that in the chat just shortly. We are recording this event. It will be posted on our website shortly after the event. You are more than welcome to, the speakers will speak for 20 minutes each in a sort of shared presentation by our two speakers, Bruno, Bonizzi and Jennifer Churchill, who I will introduce very shortly, followed by a 20-minute presentation by Con Keating. That will leave us about half an hour for Q&A. So without further ado, we've two academic guests. Jennifer Churchill is a senior lecturer at the University of West of England, Bristol Business School. She previously worked in policy and public affairs and first became interested in pensions whilst lobbying on what became the Pensions Act in 2007. She has subsequently done academic research on pensions across Europe, Latin America, and East Asia. Bruno Bonizzi is senior lecturer at the University of Hertfordshire Business School. His interests include financial integration and financialization, with a special focus on the role of pension funds in the UK and emerging economies. Con Keating is a retired financial analyst. He's currently the chair of the Bond Commission of the European Federation of Financial Analyst Societies, having previously chaired for 7 years the EFAS Committee on Methods and Measures. So he's had an extensive career in private finance, including a decade of researching and developing risk management tools and models. So he's worked extensively on pension design, including for projects undertaken by the World Bank and the OECD. So very, very warm thank you to the speakers for accepting the invitation and for being here. Yeah, it's an honor to host you. So without further ado, we'll begin our presentation by Jennifer and Bruno.
Thank you very much. Thank you. That was a lovely welcome, and I'm very happy to be here. I'm going to, as Christina just said, I'm going to take the first half of what's a joint presentation with Bruno. We co-authored, along with another one of our colleagues, Nina Caltabruna, a paper that came out earlier this year, which talks about pension funds and their potential to be destabilizing institutions in today's financial markets. We didn't quite realize when we were writing the paper how quickly it would become quite relevant. But we, what I was going to do, I was asked to try to acknowledge the fact that the audience might not be financial experts. So if you'll forgive me, if you are a financial expert, I do start off with some basics about what you've probably all heard about now, liability-driven investment. But then I want to talk a little bit about our academic perspective. We've tried to think about how pension funds behave within financial markets as they exist at the moment. So we look at how financial markets have evolved over the last few decades, and by understanding the evolution of financial markets, it's easier to see clearly the mechanisms by which different financial institutions can then interact with that institutional setting. So I'll talk very briefly, I won't get too deep into the theory, but I'll talk briefly about that. Then that will open the way for Bruno to be able to talk in a bit more detail about those mechanisms, specifically relating to pensions and the instruments that they have become entangled with, which have some problematic consequences for financial stability. And then, of course, talk about specific examples of that instability. So the 2020 dash for cash, and then the 2022 mini budget meltdown. Okay, so LDI basics. So to give you some background about me, I, after working in public affairs, decided to go on the other end, the other side of that relationship, and go into politics a little bit itself. So I was elected as a local councillor, and because I had a bit of an interest already in pensions, I volunteered to sit on the pensions committee. So in local government, unlike most of the civil service, the pension is run on a funded basis. So there's something called the Local Government Pension Scheme, the LGPS, which is in fact a very large pension fund. And when you are a councillor and you sit on the pension committee, you act in a similar, it's sort of a similar role to being a trustee. So you have to make decisions over asset allocation, and you have to take on a bit of a governance role, make sure that your part of the scheme is being managed correctly. Now, it was a bit of a daunting role to begin with because I didn't know too much how you go about trying to manage a pension fund. But luckily, as soon as I sort of opted to do the role, I was assured that there would be training. So I was very relieved. But then I was slightly disconcerted to find out that, in fact, the training was offered by the asset management industry itself. And so there was a little bit of a conflict in interest because the people who wanted my business to manage my funds were going to be the very same people who were offering me my training in asset management. Okay. So I went along to several training events, and I quite liked them. I found it very interesting that that this conflict of interest was not being in any way discussed or acknowledged. And I was interested to learn about fund management. And I also went, I have to say, at the same time, I was also a student as well as being a counsellor. So I also went for the free food, which was particularly high class. I've got a little bit of an example here of the type of thing you could expect on a training day. So I went to about 3 training days. I think in the end, I went to one by L&G, I went to Schroders, I think I went to a couple others. So yeah, I was quite well fed. So what did you learn on a basic training course? You learn about asset allocation, of course. So on the asset side, you need to make sure you have a diversified portfolio, which means you need to put your investments, make sure you share your investments between a range of different assets that have slightly different characteristics. So for example, you might want to put quite a lot of your investment into equities, which is the word for shares. That would, you'd be buying shares of particular large corporations, can be UK, it doesn't have to be UK, so geographically you have some choice as well. And you would hope by owning these shares that you would end up participating a little bit in the profits of the corporate sector if they choose to pay you dividends, and you would also be hoping that you would benefit from any kind of increases in share prices. Other than shares, you might decide that you would invest in bonds, so fixed instruments where your return is a little more guaranteed but tends to be lower. So normally when you're looking at asset allocation, you're thinking about what kind of return can you expect, but also what is the volatility of that return? How likely are you to get the return you're hoping for? Outside of bonds and equities, the 2 main assets, you have a whole kind of distinct other class. So you have alternative assets. That can include property, commodities, and what has become a lot more popular, private equity, hedge fund investments, and pooled funds, but we'll come to that later. And you might have some cash just for basic liquidity purposes. So one of my main responsibilities managing the fund was to kind of make the decisions about how much of each asset I would want in my portfolio. Okay, so that I was expecting because I did know some basics about corporate finance. What was newer to me when I was being trained was a large focus on funding levels. So funding levels were understood as some kind of discrepancy or the level of equality between a value of your assets and some value of your liabilities. How we value liabilities, however, you're thinking about what's going to be, how do you value the future pensions you're going to have to pay? And there are several things that can have an impact on the level of those pensions. So quite often, so the LGPS is a defined benefit fund, which means your benefits are defined in advance. So your pension will be some proportion of, it used to be final salary, now it's your career average salary. But they would be index linked, so they will go up with inflation. So changes in inflation will have an effect on any calculation you make of the value of your liabilities. Also, you will be affected, changes in longevity will affect you. So if people start living longer, then of course you're going to have to pay pensions for longer, so your liabilities will go up. And then finally, the value of your pensions are affected by interest rates. And as I was taught, the reason why interest rates are so important is because regulations have determined that we will value liabilities in a specific way by using a version of present value. And to remind people, if they've forgotten or if they've never seen present valuations before, when we work out present value, we're doing a reverse operation of finding future value. So if you imagine you put a lump, a sum of money into an interest-bearing account, in order to work out how much money you'll have perhaps in 5 years' time, you need to know what the interest rate will be, and you multiply the sum you put in at the initial moment by 1 plus the interest rate, to the power of the amount of time that you leave that money in the account. And when we work out present value, we're simply doing the reverse operation. So if we have a future value, we discount it. So we divide it by 1 plus the interest rate to the power of the amount of years that we're talking about in the distance. So you discount the future rate once you've tried to calculate it. So we have, there are some additional decisions to make once you decide you're going to use present value of liabilities. You have to decide what you're going to use as your discount rate. Which interest rate are you going to put in there? And the decision was taken to use a market-based discount rate. I didn't know at the time to question that, so I'll zoom through and I'm sure we'll come back to it. Now so here we come to liability-driven investment. So what is the general idea? We're trying to keep our assets and our liabilities to be at the same value, but one of them, the liability side, is being measured as present value. So we know that if there's a decrease in the interest rate, because that's the denominator there on the calculation for present value, we know that the present value of liabilities is going to increase. So how could we make sure our assets increase when there's a decrease in the interest rate? How could we make sure that our assets move in the same direction, have the same interest rate sensitivity as our liabilities? This is the overall program of liability-driven investment. And the most simple way we were taught about was simply hold bonds, because hopefully the prices of your bonds will be going up if market gilts are, the interest rates, the yields are going down. That's a kind of a financial relationship. So on the asset side, the value of your gilts will be going up, when on the liability side, that decrease in the interest rate will be pushing your liability value up as well. So you can hopefully kind of match the movements across your liability and asset side. And therefore you could keep your funding ratio at a level kind of keel. That's all well and good if you were at 100% funding in the first instance. So if you happen to have a fund where your liability present value was equal to the value of your assets. What if you're not fully funded in the first place? And this was the first question we asked as members of the LGPS, because there had just been changes in the assumptions on longevity, for example. So everyone had been assumed to be about to live longer, and everyone's funding levels were looking pretty poor as a response to that. Luckily, we've had austerity, so that's no longer such an issue. Pension funds are possibly the only people who are a bit happy about that. But what if you're not fully funded in the first place? Is it that sensible to put all of your investments into bonds? If we remember back from our asset allocation decisions, bonds are very low return. So if you do want to increase your holdings of bonds, you're going to need growth from elsewhere. So you're going to need to perhaps, on the other parts of your portfolio, you're going to need sort of a part of your portfolio which is your growth, focused on growth. And it might need to come out of even equity. Equity might not be exciting enough. It might need to go into private equity or emerging market equity, or just it might need to chase yield. It needs to go wherever it looks like return is the highest. But we have to remember that where return is highest, it does also tend to be most volatile. Other than trying to get higher growth assets onto your portfolio, you could also get involved with some financial wizardry, and this would be the conclusion of all of these training days. What we could do is we could not worry our pretty little heads about it, but we could allow the asset managers to limit our requirement to hold bonds by creating for us what they called synthetic duration, playing with some leverage and with derivatives, and everything would turn out right. We'd get growth and our funding levels would be stable. And as it happens, in the LGPS, we sort of ignored, I don't know if we just had straw in our hair, but we didn't really take this advice. We tended to find it a little bit disconcerting. But we did see more appetite for this type of behavior across private funds. So if we skip forward to me looking at pensions from a more academic point of view, with this sort of background knowledge of LDI being pushed in the industry, I was looking at asset allocation, and I did my PhD on pension reform across Europe, and then started working with Bruno looking at asset allocations. And we did a paper in 2017, and we were looking across several countries at this move away from equities towards alternatives, and we tried to frame that partially as, is this being driven a little by LDI strategies, or just a more general concept of liability driven investment outside of the asset manager's view, but from a broader market-based perspective, which I might try to get to. And then Bruno and Nina Calta-Bruno, who I mentioned previously, published in 2019 another paper looking at emerging market demand, so from the global north, investment into emerging markets, showing emerging market asset demand being determined by liabilities, and showing how that therefore makes it quite unstable, and it doesn't depend on the characteristics of emerging markets. It depends entirely on what's going on kind of from the investor's sort of geographical viewpoint. Okay, so then what brought us to the paper that we published this year? So this paper was focusing more on liquidity concerns. So we carry on doing the same thing. We're looking at asset allocations, but we started to see something that alarmed us a bit, which just looked as if pension funds were beginning to be concerned about liquidity. And we didn't see any particular obvious reason why pension funds should worry about liquidity. It's not normally, you wouldn't normally think of a pension fund as being unable to make pension payments. It has a sponsor. So when a pension fund, for example, if a pension fund is deemed to be underfunded, then it's the responsibility of the sponsor to up its contributions and to increase the inflows into the pension fund. It's not, the pension fund itself is highly unlikely to go bust. So why were pension funds suddenly looking like other financial players and concerned about liquidity? Now, what was the basis for our claim that they were concerned about liquidity? We're looking again at the asset allocation. So we see this big drop off in the demand for equities. We see that big increase in the demand for gilts. But we also saw something that we hadn't seen in our previous work, which was a big move towards investing via collective funds. So instead of, for example, investing in infrastructure, you would invest in a collective fund that goes into infrastructure, or even a diversified growth fund, which is almost like a mini portfolio within your large portfolio, which will hold all of the different asset classes. So we wanted to just think a little bit about what was going on. So pension funds seem to be trying to secure liquidity. They looked like they were trying to hold on to good quality collateral. They looked like they were investing possibly to kind of quite a large extent in collective funds that will allow daily redemptions rather than holding assets themselves. And we were kind of wondering if the importance of gilts for pension funds, of bonds for pension funds, was not just deriving from LDI strategies. Is it something being foisted onto pension funds a little bit more by changes in the background financial markets? Is it something that's now necessary in modern UK financial markets? The characteristics of gilts is that they can, they promise ease of outright sales, so they offer you liquidity kind of function. They can be used as collateral in repo positions. And if we have a look, this is the 10-year government bond in the UK. You can see this downward trend in the yield, which is suggestive of, ever-growing demand for that particular instrument. And whilst we know we've had quantitative easing and we know that story, and we know that the central banks have been adding themselves to demand after the financial crisis, this trend, as you'll see, is much longer than that. It goes back some considerable way and requires some kind of explanation. And one part of that explanation could be this increased desire by all participants to hold on to this particular instrument for some kind of power that it gives them. So we tried to locate this in a CMF, a critical macrofinance perspective. I did warn you I wouldn't talk much about this, and as I have very little time, I'll talk even less. But we tried to locate pension funds as operating in a collateralized financial system. They're active institutions. They enter into relationships which then give them survival constraints, or what we call settlement constraints, cash payment demands that are time limited. And the problem with liquidity in the modern market setting is it's cyclical, it ebbs and flows. You have all sorts of innovations and layering of the credit system so that everything feels very flush in periods, but then as soon as market perceptions shift, then the elasticity of credit will suddenly kind of snap back, and only certain things will be counted as really seriously important in terms of trying to meet your settlements. So then the risk shifts onto the borrower in this setting, and liquidity becomes pro-cyclical. And therefore, the practical consequences is that pension funds are embedded in this system, and therefore they themselves can start generating liquidity pressures that can, in the face of margin calls, and that their behavior will then be destabilizing and can lead to its own spirals. I'll pass over to Bruno with some of the detail.
Thanks, Jennifer, and Christina. Don't worry, I won't probably won't talk for the full 20 minutes anyway, so we shall be on time. So I don't think I can control the slides, right? So I need to do. Yeah, I will just tell you next. So yeah, just kind of continuing on from what Jennifer said, just a little bit of additional detail about what's involved in this new strategy, especially the LDI ones, which were at the core of the instability back in September last year. But just to recap about what's been said so far, pension funds have become more careful about their liquidity, and we see that in the management of their collateral. We argue also in the increasing use part of pool funds, partly that can be explained by greater attention to liquidity, and generally speaking, their larger allocation to gilts. So that's kind of one big trend. The second one, which Jennifer has also mentioned, is the greater attention to funding ratios, the sort of the funding levels as sort of the key goal that pension funds seek sort of to monitor as they decide their asset allocation, and as part, of course, of their periodic regulatory exercises. And then finally, with all that, they also try to keep returns high in a world where, at least until last year, interest rates and returns on safe assets are pretty low. So in some way, these three objectives and these three sort of trends are hard to square. They're hard to sort of make compatible. It's hard to keep a liquid portfolio, a high and stable funding ratio, and also high returns that are like kind of high enough to pay pensions when they're due. So it's kind of hard to square the circle, and this is why, in many ways, leverage comes in as a way to sort of bridge that gap. So if we move on, the main way in which pension funds use leverage as part of their LDI strategies are through repos and through interest rate swaps. So here, looking at repos first, I presume people know what repos are. They are repurchase agreements. You can kind of think about them as a sort of a form of collateralized borrowing. So here, the pension fund, which has increased its allocation to gilts, so they have a lot of government bonds in their portfolios, can use such gilts to borrow to leverage up their portfolio. So they would, I don't know, go to a bank and borrow additional cash by using their gilts as collateral. Now here, just to clarify, we are simplifying things a bit. Of course, in many cases, it won't be the pension funds directly doing that. It would go through a manager or indeed a pooled funds that does that for them. But the sort of relationship that is built is one where the pension fund is sort of leveraging up through the usage of gilts as collateral. And of course, because it's a form of borrowing, the pension fund will pay a certain rate for that borrowing. But the good thing about this is that, of course, by leveraging up, it can have more cash to invest into something else, for example, into another gilt. So in a way, by using a repo, you can sort of double through leverage your exposure to gilts. And why would a pension fund want to do that? Well, as part of the LDI strategy, pension funds seek to sort of increase their exposure to interest rate sensitive assets, which can stabilize their funding ratio. So remember, that's sort of the ultimate objective of LDI as a strategy. So repos through leverage allow you to increase that exposure. And so in the right-hand side, you see just some figures. That's the total leverage of the pension fund sector as a whole over time as a proportion of total asset. There's a gap there. That's because the ONS has changed the way they report pension fund statistics. Unfortunately, in 2018, they didn't do neither the old version or the new version of that. So when this borrowing is, when it comes to pension funds, almost entirely in the form of repos. So next slide. The other way, as I was mentioning, which pension funds can sort of leverage up their LDI portfolios is through swaps. And swaps, interest rate swaps. So how does that work? Well, pension funds enter, again, through a manager, most likely, rather than directly, an agreement with some other financial institutions in which the pension funds pays a variable rate and receives the fixed rate. So this sort of relationship allows, once again, the pension funds to increase its exposure to assets that move more or less like the liabilities of the pension fund. So in other words, it hedges the pension funds against interest rate risk, so that the funding level is stabilized. So for example, if interest rates were to fall, well, that in a way means that the pension fund is paying less than what it receives, and so the value of the interest rate swap would increase. And so in terms of the balance sheet of the pension funds, the assets would increase just as much as the liability would because of the increase in interest rates. Again, on the right-hand side, you see the value of derivative contracts for the pension fund sector as a whole. This is not just swaps, it also includes some of the foreign exchange derivatives that they have, which are used as hedge on their sort of overseas investment. Now, one thing that I should mention, if you look at the sort of the scheme on the left there, is that when it comes to swaps and indeed repos, these transactions are collateralized in the sense that there is a margin requirement that you need to keep up in order to keep your interest rate swapped. So as the value of the contract changes on a daily basis, you might be asked, depending on in which direction it goes, to post collateral, extra collateral in the form of additional variation margin. So, for example, if your interest rate swap decreases in value beyond a certain limit, you might be asked to post additional collateral to keep the swap. And that is, as we will see, is sort of the source of the trouble that we saw in September 2022. So to wrap up this discussion about repos and swaps, so these appear allegedly to help pension funds achieve sort of all their objectives at once, in the sense that first and foremost, they are marketed as a way and have been used as a way to stabilize the funding ratio. Because, if interest, as I was saying, suppose that interest rates fall, then the liabilities of the pension funds would increase, but then the value of not only the gilts that the pension fund owns, but also of their repo and swap position would increase. And so by so doing, they managed to stabilize the funding ratio as the assets would change as an increase as the liabilities are. But by so doing, you don't have to actually commit the entirety of your portfolio to gilts, which would be a more direct way, right, to hedge your interest rates risk in that same way. So that means that, once again, this frees up additional capital that can be invested into other things, or to double and increase your exposure to liability hedging assets. And so that's why it was seen as a sort of popular instrument. So you leverage up, you increase your liability hedging exposure, and that frees up capital to invest in other things like infrastructure or equities or property or whatever. So the third thing is that this is, as I was saying, all collateralized, and thus in theory, it's a secure type of transaction, right? So the change in the value of these contracts, which is generally daily, done on a daily basis, is sort of fully reflected into the changes in the collateral values and margin calls that might come as part of that. So in that way, it reduces, that's, I guess, the point of the collateralization in the first place, the sort of risk of your counterparty defaulting on their side. And the other thing that I suppose we should add once again is that the repo market in particular also helps pension funds, not just with this direct kind of managing of the funding level, but also it's a way to raise cash should such a need arise. So if the repo market works, then pension funds which have sort of yields to spare can sort of maybe meet a cash flow obligation by borrowing through the repo market. And so that also helps in a situation where pension funds, because, and we're mainly talking here about private sector pension funds, the level of sort of basic cash flow coming in, that is the contributions of the workers compared to the benefits they are paying out, is increasingly becoming negative as many of these pension funds have been closed to current private sector workers. So there's basically more people receiving pensions than workers contributing to the scheme. So it all seems to work out, right? And it seems like a good and sound strategy in principle, right? But of course, what if the opposite happens? What if interest rates rise, and what if they rise quickly in a way that is sort of unpredictable or, higher than expected? Well, that's in a way what we have seen in the episodes, especially the latest one in September 2022. So if first we look at the previous episode in March 2020, so there was no widespread sort of focus on what pension funds were doing, because of course that was the beginning of COVID. We had lots of other issues going on in financial markets, and then of course much beyond that. And it was also a bit more short-lived, but still, if you go through some of the Bank of England reports, for example, about that period, you see some of these dynamics playing out in reverse, in the sense that depreciation of the pound and the interest rate increase in bond markets effectively worked as, like I said, in reverse in terms of the process that I've described. So, for example, they would decrease the value of the liability hedging positions of pension funds, meaning that they wouldn't be required to post additional collateral, i.e. they would receive margin calls to keep those positions going. And these margin calls, I should add, also are cash. So you can generally replenish your collateral in the form of additional cash that you have to post. And of course, pension funds could try to do that through the repo markets, as I was just mentioning. That's one first way in which you can try to sort of raise additional cash to meet your commitments. But of course, when there is general financial sort of turbulence and increasing yields, meaning, of course, decreasing yield valuations and prices, that makes using the repo channel harder. And so eventually the final way in which you can try to meet any margin call is by selling assets and raise the cash necessary to keep your positions. So in this way, you can see that the pension fund sector, if you can call it that way, was contributing to the procyclicality of the system, in the sense that it was contributing, just as everyone else was selling, to further add sort of downward pressure on asset prices in that period. And of course, something very, very similar happened in September 2022, just on a more sort of concentrated but yet larger scale. So of course, we remember the mini budget in September. I think it was Friday the 21st or something like that, if I remember correctly. Anyway, that was not, for whatever reason, well received by the markets, and started adding sort of upward pressure on gilt yields. And you can see that that's the 10-year generic sort of 10-year yield from the Bank of England's website over September and October. So you can see that it increased quite quickly in a very, very short amount of time. And so what this generates is essentially a very, next slide, Jennifer, a very similar type of dynamic, in the sense that an increase in interest rates, in this case gilt yields, puts downward pressure on the collateral and derivative positions that pension funds have, which eventually generates margin calls. So pension funds received a lot of them, and I'm sure we're going to hear a lot more about this in the next presentation by their manager. So, asking them to replenish their collaterals if they want to keep their LDI strategies on. And some of them tried to do that, but eventually, of course, that generated a downward pressure in parts of the gilt market, especially in the parts where pension funds are mostly invested, typically the index-linked part of the gilt markets, which pension funds try to sell in order to raise cash and therefore replenish their margins. So you see how the cycle goes. So the generalized sale pressures to replenish collaterals. So that generated considerable damage. So this is data from the ONS. That's sort of over 200 billion aggregate loss. So that's not that's sort of for the pension fund sector as a whole. But most of it, of course, was in the private sector, the defined benefit part of it, which is the part that actually does LDI to a large extent. And some of these losses are directly in the LDI parts of their portfolios. And indeed, as I was mentioning, in the gilts, in their gilts investment, especially in the index-linked gilts investment. I just wanted to sort of conclude with this kind of more open questions. First is, I mean, the way we framed this presentation was mainly about the financial stability angle. Our paper tries to sort of link that more broadly with discussion that has been going on for a long time about whether pension funds can be patient capital. And, our angle here was to show that through things like what we've just described, pension funds have been sort of not really able to be sort of patient capital in that way because of the greater attention to liquidity, because of their focus on LDI and funding ratios, because of the fact that these activities generate margin calls and collateral calls, which prevent effectively pension funds from, or refocus the time horizon of pension funds in a more short range. So they are not very well able to be patient capital, and they can also, as we've seen, contribute directly to financial instability, especially in the gilt markets, as we've seen in the episodes that I've just described. And then if you turn to the final slide. I think there are still open questions, although we have seen what happened. I think one interesting question to me, and which we might need to tackle at some point, is how much of this is just a UK phenomenon? Because of course there are some specific structures that made UK pension funds in particular to engage with this kind of strategies more so than perhaps other pension funds, defined benefit pension funds in other countries. But the idea is it might be sort of prevalent in the UK. It is not just, it also exists in other countries, and yet they didn't have that kind of dynamic. So it's interesting to me. It would be interesting to me to fully appreciate why. And more generally, sort of the usage of derivatives to hedge pension funds portfolio is not just a UK phenomenon. So again, why is it that we don't see those sort of spiral type of dynamics in other markets as well? In the UK context, I guess the two big questions for me are, first, to what extent the compositional change in pension fund assets will change these dynamics. So we all know that defined benefits are still the largest part when it comes to the size of the assets, but over time, defined contribution will probably take over, as most of the contributions by current workers are going into DC schemes. So how is that going to change the dynamics we've just described? Because they don't use LDI, for example, of course. And then I guess the final question is, what's the future of LDI specifically? Is it going to continue as it is? Is it going to change? Are pension funds more wary? And there has been some significant scrutiny on it. There have been, by the Parliament, by the Bank of England, by the pension regulator. But I don't know to what extent things have moved, because I suppose ultimately the asset manager industry has an interest, of course, to keep that market segment going. And I'm actually very happy to hear more about this, I'm sure, in the next presentation. Thanks. I'll stop here.
Okay, wonderful. Thank you both for your presentations. And we're just going to move swiftly to Con Keating's presentation, who I believe was also a contributor to the parliamentary inquiry by submitting evidence.
Let me just begin by saying the first thing to understand about LDI is not all private sector schemes did it. We estimate, that's Ian Clacker and myself, that the depth of penetration was between 80 and 85% of schemes by number by midsummer 2022. Derek Scott asked in the questions why local authorities did not do LDI to any meaningful extent. The answer to that is quite simple. One of the driving factors for schemes doing LDI in the private sector was that the pensions regulator was actively encouraging it. Arm twisting was the way it was put to me by one person. The pensions regulator, of course, does not oversee the local government scheme or schemes, so they chose not to do it. Let's go to the first slide, please, Christina.
Mm-hmm.
Let's begin on the topic of liquidity, and we'll start with the top left-hand diagram here, which is the performance of over 15-year gilts, their daily returns, and the cumulative arrangement of those over the period of the March 2020 dash for cash. Now, the first thing to understand about the dash for cash is that it was a global phenomenon. It was not confined to the UK or the US. You can see here also that the net cash call, though you have a high to low of around 16% in collateral calls over that time, the net position was minus about 8% of the capital value of the underlying gilts. You can also see the specific effect of the Bank of England coming in and announcing the reopening of quantitative easing. That quantitative easing is, I will contend, exactly what caused the current inflation that we are suffering. But we can talk about that separately. Now, what's interesting about the September and October episode is that it's intrinsically different. We see not a move from positive collateral being held to consistently negative and cumulative, and it's on a far larger scale. We see collateral calls amounting to about 30% of the value of the gilts being repoed or bought under derivatives operations. Then we see the rally resulting from the bank's intervention on the 28th. Could we go to the next slide, please, and bring it all up? All right. Start with the diagram in the right-hand corner, lower corner. That's the returns for different asset classes over the month of August. And you'll see the index-linked gilts, fixed income, corporate bonds, and even UK equities were negative over the period. So you had a month prior to September in which collateral calls and collateral generally would have been being spent. What is interesting is that emerging market equities was actually a star performer that month. The next month, quite amusingly, you will find that it was emerging market debt which actually gave the highest returns over the period of the crisis. Now, let's just look at in some detail at the events here. The first thing is that the crisis did not start with Truss and Keating. It started with the Bank of England's raising of rates on the Thursday, the day prior to the budget announcement. There's about a 25% movement there in 30-year gilts. For whatever reason, the bank seems to want to forget that episode. You then see a similar order of magnitude, perhaps marginally larger, the next day on the day of the budget. The element which caused complete and utter chaos was that over that weekend, even though there had been substantial collateral calls coming in at the close on Friday, over the weekend we had both Truss and Keating doubling down on the nonsense of that budget, with the result that the market on Monday morning opened down as far as people could take it. It really wasn't a very pleasant experience. Now, I just want to say, these are conventional gilts. An awful lot of what's been going on is actually taking place in linkers. If you look at the previous dash for cash, you will actually see that throughout that period, the pension system was a net buyer of linkers. In fact, during the crisis, the pension sector did not become a net seller of gilts, of index-linked gilts, until the Monday morning. Next slide, please. Let's just ask, did LDI work? LDI consists of borrowing money or buying derivatives, which are, of course, leveraged instruments. The exercise is not one of matching cash flows. It is there to hedge the variation in capital values from valuation to valuation. Most of that variation comes from the discount rate being used. Separately, we can have a discussion about whether or not it is in fact legal or lawful to use either repo borrowing or derivatives for the management of liabilities, but that's a separate question, and we've published in the legal journals on that. Let's just answer the question, did these strategies work? Well, it's a nightmare to try and unwind exactly what schemes did over periods that could go back 25 years. LDI really took off in the wake of the resolution of the global financial crisis. And you can really date it from Gordon Brown's interventions, which were the first of those designed to resolve the global financial crisis. Now, with which in mind, given that it's really not practical to try and recreate exactly what schemes did, as schemes adopted LDI at different points in time. But what we can do is look at a few telltales. This is, if you like, one of the most basic strategies, which is part of LDI. It consists of buying a 20-year gilt with 6-month repo funding, holding it for 6 months, then reinvesting the fund, doing exactly the same thing again and again, and looking at the cumulative value which accrues to this. And you will see that that strategy reached a peak. The dates are missing off the bottom. Reached a peak in 2020, which is about 230% higher than the original investment. One becomes 2.3. It made a great deal of sense. People were earning a very large margin on gilts relative to short rates. Once rates started to tighten in late 2021, we saw a collapse in the value of that trade. And at the end of the period, so in this period is from the middle of 2008 until the end of 2022. At the end of that period, that strategy is 7% above its initial start point. So, and if you adopted that strategy at any point other than after the first year or so, you've lost money. Next slide, please. This is the same thing, a slightly different telltale. This uses the 30-year interest rate swap. A 30-year interest rate swap had a duration of around 15 years and is a reasonable proxy for the sort of derivatives exposure that might have been held by pension schemes. The point here is that what we're looking about is net collateral freed rather than a reinvestment sum. What we are doing is we are taking the swap, buying it at the beginning of the month. At the end of the month, we sell the swap, buy a new swap, and hold that for a month, and so on. And the collateral receipts are shown there as the bars, the cumulative position as the yellow line. We see that, in fact, by buying derivatives, by buying interest rate derivatives, you would have been a net receiver of collateral amounting to some 35% of the notional value of the contract. So if you had £1 million contract, you would in 2020 have been some £350,000 better off. It has, in common with gilts, collapsed in the period 2021 through to 2022. What is interesting about that is that you will see the majority of the collapse occurs before September. Okay, is that September is that second large downward lag. Can we go to the next slide? Swap rates and cash. These are swap rates and cash. Can you bring up the next? Right. There's a basis between swap rates and cash. Let's just go to the next slide. We'll save some time here. We can come back to this if needed. I just want to talk a little about index-linked gilts. The instrument most widely repoed by pension schemes was in fact not conventional gilts, but index-linked gilts in the period up to the crisis, and indeed since. The bottom right-hand diagram shows the real yield on the 10-year index-linked gilt. Note that at the lower right-hand end, there is no real sign of the dash for cash. As far as the index-linked gilt market is concerned, it really didn't happen. Now, the diagram on the left-hand side tells a story which is a problem. Index-linked gilts are widely used by pension schemes to hedge their inflation liabilities. It doesn't work, plain and simple. There's a regression line there shown. It's index-linked gilts have rather nasty liquidity properties arising from the concentration of ownership of index-linked gilts. 80% or more of index-linked gilts are owned by the pension sector, and at one point in time that may have been as high as 92%. The result of that is you see excessive movements in trends. You see yields which grow unreasonably low. The low on the 10-year is minus 320 basis points. That's to say schemes were holding and buying index-linked gilts which were returning retail prices less 3.5. In the crisis, that has changed completely, and where they were much sought after by virtue of the fact everyone in common is selling them, they became very, very difficult to give away. The 2068 long 1/8% linker moved from a spread of minus 2.15%, that's retail prices minus 2.15% in December 2021, to a spread of RPI plus 2.1 in the crisis. That's 4.25% in real terms, about twice as much as conventional gilts move. So you really can't talk about the crisis without talking about linkers. And one of the important things to understand is that the Bank of England has a natural aversion to buying linkers. Quantitative easing operates only in conventionals. They, by repute, only agreed to include linkers in the wash-up at the end of their period of intervention, because the debt management office reminded them we were planning on financing approximately 25% of our public sector borrowing requirement with linkers in the coming year or two. Can we go to the next slide? Now, it's pretty clear that as yet we have not seen the end to this. Here are a couple of slides. Here are 3 slides from the monetary statistics. They indicate that M4 lending generally has gone down, and it has been driven principally by lending to pension funds and fund management lending. Fund management lending is effectively the repo borrowing of pooled funds. It's fallen by some £55 billion. If we look at pension funds, we see the same thing from September, a fall of about £20 billion. This is clearly showing us that the rebalancing and the full recognition of costs is still taking place. Next slide, please. Let's talk about rebalancing. Here's a couple of slides of a pension scheme. We see in the bottom right, ignore the 21 and 22 and 21. They're in fact 2023 and 2022. We see that this scheme had 23 billion of assets at the beginning of the year, which became 13, a decline of 41.8% of its assets. These are IAS numbers. They're taken from the sponsor corporate accounts. The liabilities fell by 31%. These are very different numbers from those being told by the Pension Protection Fund. Now, what you will notice is the funding ratio for their scheme, which was heavily involved in LDI, as we'll see in a moment, fell from 114.6% to 97.1%. It now represents a charge on the company rather than a surplus. If you look then at the balance sheets, the comparison, the asset portfolios between 22 and 23, you will see very, very significant selling of equity and bonds. The declines in value of property and alternatives could be ascribed to market movements. We don't know whether they were sales or not. I want to draw your attention to the cash position. At the beginning of this period, of that £1 trillion of cash, oh, sorry, that's billion pounds of cash. The approximately half was cash being held by derivatives counterparties. The decline in cash holdings is, I think, in very large part because they wound up some of their derivatives positions. But the thing which is just simply amazing is that they've actually increased over the year their cash commitment to their liability-driven investment portfolio. And it has gone from 23% of portfolio assets to 44%. Now, over this period, with rates rising from 1 to 4, the actual interest rate longevity and inflation exposures of this scheme, because of that movement in interest rates, has roughly speaking halved. So we have a fourfold increase in the relative commitment to LDI, which has cost them some 16 or 17% in funding ratios. If someone can explain the logic to me, I'll be very interested. Let's go to the next slide. Another illustration of a scheme. If we begin with the top left-hand picture, that shows that this scheme at first pass appears to have increased its funding ratio from 152% to 161%. That is a denominator effect. It comes about in spite of the fact that the scheme actually lost more money on its assets than it made on its liabilities, but with the denominator of the funding ratio being lower, then so the funding ratio increases. Now, if we look to the asset portfolio, we see a quite remarkable sale of equities. 84% of them have gone. That's sale, that isn't just mark to market. The unquoted could possibly be a mark to market, but similarly, the declines in bonds at 50% or so are quite clearly large sales of bonds. This scheme has bought in an insurance policy covering most of their pensioners in payment. We'll come back to that. What I just want to draw your attention to is the cash item. 56 million last year becomes 366 this. That tells you two things. They had something in the order of 1.75 billion of interest rate or repo exposure. That's what gives you a 310 million pound call. And it also tells you that those contracts are still open. Okay. One of the things we can take out of that buy-in is we can estimate the performance, the risk exposure of the non-bought-in assets, which of course are longer in term, and that's a negative 38% or so, which is quite low. But the point is, the buy-in is a matching of cash for individual pensioners. Technically, it's a defeasement. It should really not be included in those accounts. Now, if you take it out, you see some very interesting results. The total performance on asset side X buy-in is down 41%, and the liabilities are down by 36.5%. This means that rather than being 152% funded a year ago, it was 124%. And in line with common sense, it has actually fallen to 115%. This is quite clearly still being kept open. This is as at March. Let's go to the next slide. We'll just use this as my last slide. We have looked at the distribution of funding ratios. We collected a process which is painful and extreme. The funding ratios a year ago and at the end of 2022 for some 350 schemes. That's what is shown in the top right-hand side. We see some improvement in funding ratios overall, from 95.4% in the prior year to 102.1% in the subsequent year. In that distribution, you can also see that there are quite a few schemes which actually had funding ratios which deteriorated. 32% of our sample, 350, had funding ratios which deteriorated. This is a very different story from the story being told by the PPF, which is the story on the right-hand side. The red or brown lines, the yellow lines perhaps, are PPF's numbers. The blue are our sample. Of course, our sample it's nowhere near the size of the PPF. We're about 7% by number, but the differences are sufficiently large. And even after adjusting for the difference between a PPF Section 179 valuation and an IAS 19 valuation or a scheme valuation, these differences are simply too large. The PPF's idea that schemes have improved by as much as 20 or 25% simply do not bear water. Nor does it seem likely that anything like the number of schemes will prove to be sufficiently well funded to approach buyout immediately. Do you want to just bring up the last slide and we'll leave it there? That problem remains slide is quite important. The thing to understand is that you can't hedge the DB sector entirely using gilts. There just aren't enough of them. And the very last slide was saying something different, which is about the new funding regulations, which have this idea that one should be having a completely de-risked portfolio, intrinsically a gilt plus bond portfolio, at a 12-year duration and beyond a 12-year duration. The effect of last year's movements in duration on a sample of schemes, not the same 350 sample, a sample that we collect every year, which has over 70 schemes in it, is that the modified duration, the median duration of that sample, which was 16.3 years, because of the interest rate movements last year, became 12.9, which would make the rush to get into low dependence, low volatility, gilt-based portfolios insane. Leave it there.
Thank you to all the three speakers. We've got a bit of time for Q&A. I haven't been able to monitor the chat, but I have seen a few questions in there. Before we get to them, if there's any people in the room who would like to directly ask a question, feel free to use the raise hand function at the top there, and we'll take them sequentially. Okay, we have one by Tom. Tom, hi. Feel free to unmute yourself and direct your question. I should say that we will take maybe one or two, collect a few just to help with time.
Thank you. This arises from some work I did on the gas market last year. I was actually called out of retirement to do it. Try to work out what was going on with the huge price changes that there were. And one of the effects, as I've put in on the chat, important element was the impact of margin calls on electricity generators, which is actually a very similar effect to what happened later in the year to the pension funds, I believe. That is the effect on them of a huge increase in margin calls arising from the increase in gas prices, with the impact on having to call in a lot of collateral, which is actually, that was the reason why so many of the smaller, less experienced electricity companies in this country collapsed in the tail end of 2021, beginning of last year. I'm just wondering, this is a comparison that struck me very sharply when I was doing this work last year. May I quote very quickly from the Financial Times of September the 4th last year. On Sunday, Finland warned that the energy sector was facing a potential Lehman Brothers moment if governments did not provide emergency funding to help providers, i.e. electricity providers, meet spiralling collateral requirements caused by soaring wholesale prices. through the intermediary of the futures markets. I was wondering what interest the speakers have in this comparison, and through that, taking it more broadly, the whole question of financialization and how far, in fact, derivatives can lead to destabilization of markets rather than helping to stabilize them.
Thanks, Tom. Any other questions in the room? I've got one. I'd be interested to hear speakers' thoughts on what could provoke sort of more unraveling of this system. I know it was mentioned, especially by Con at the end, that this is far from over. So I'm just wondering where you can see possible vulnerabilities and sort of shocks coming from. Oops, I can see a few comments in the chat, and one question by Derek Scott on why LGPS didn't and don't use LDI. This question is more directed to Jennifer about how LGPS, your particular one that you were working in, pushed back against the LDI presentations made by asset managers. So with these three questions, we can maybe ask for the speakers to quite quickly try to address them as best as possible.
All right, cool. I'll take the one directed to me in the interest of time. As was already kind of mentioned by Con, we weren't in any way pressed by regulations to take on these strategies, and so we were all just a bit cheeky. I mean, it's not a very interesting answer, I'm afraid, but I just ate the food and ignored the press by the financial asset managers. So we we were very conservative with both a small and a big C at the time in terms of what we did with our portfolio. So we didn't even invest in emerging markets, because the other members of the committee said to me, if you invest in multinational corporations in the US, they will be extracting value out of emerging markets. There's no need to go there directly yourself. So, but no, we didn't. If we did have a problem with our funding, there wasn't much of a big, if we came up with 70% funding levels, the onus was just for us to make some sketchy plan about how we would recover it in the next 3 to 5 years, which no one followed up. So it wasn't particularly alarming for us. I'll pass over, Bruno.
Just before, sorry to interrupt, Bruno, before we continue with your answers, maybe it's a good opportunity to just invite Neil to also pose his question, and then we can wrap them up with your final responses. Neil, sorry, I didn't quite pick up your question from the chat.
Yeah, I thought maybe just state it. So, but to me, what links all three of the talks, and I think we saw it with the linkers, is that we had that period where inflation, we had this myth, didn't we, that it was a low inflation environment and inflation targeting would work, and that just blew up. And that created this stress in the linker market. Actually, probably at the moment, the best hedge for inflation is equities, because they're all marking up and getting huge profits, and that's coming through in the equity market. So just a comment to all of them, what do you think about that inflation targeting failing? There's a failure of theory here.
Can I come back to that last question? The situation until the beginning of pandemic and the dash cash, and the reason that the first rounds of quantitative easing was not inflationary, in spite of it being quite massive monetary expansion, was that the demand lack was one of demand. Now, what we saw with the shift post-COVID, and partly as a cause of COVID, was problems on the supply side. So the Bank of England's arguments that they made last week to Treasury have a degree of merit. They weren't really inflationary in the old world, but they emphatically were in COVID and post-COVID. That implies for me that bringing down inflation is going to be a much more painful process than we have seen so far. And I think we saw the first indication of that with Wednesday's CPI number. That, if you like, is the macro view. It also suggests, actually, that with index-linked gilts now returning RPI plus 1% or more, they may actually be a safe haven.
Yep. Okay. Bruno, do you want to have the final word?
I guess I can answer the like Tom's point, which is the one that wasn't addressed. So yeah, I think I would agree with your broad conclusion that, you know, what this shows is that I wouldn't say just, you know, derivatives per se. I guess that's a too big a point. I don't feel comfortable making, but certainly that, you know, the way they are managed, you know, with the daily valuation margin requirements can have destabilizing implications, and so that's what the LDI debacle revealed, I guess. So yeah, I think that's a fair point.
Can I just add to that? You know, what we've seen with LDI, the DB pensions savings were naturally a reservoir of financial stability. Their liquidity demands were small and highly predictable. The total pension payments in a year, and I saw Derek ask this in the course of the comments earlier, are about 50 billion a year, which is really very small. We saw collateral calls in a single day in excess of that amount in the crisis. Okay, which gives you an idea of the relative scales. The point is that by moving to derivatives and repos, then what you are doing is giving up this long-term natural stability role and becoming, in essence, a bank sensitive to market-driven rather than consumer-driven demands for cash on a daily basis. It wasn't criminal. It probably should have been.
Thanks, Con, for that really succinct kind of summary at the end. I think that really nailed the point of this whole event. So I think we should be, well, warmly thanking our speakers for their time and effort to present to us today. I think it's been a very useful session for maybe experts and not so experts alike. So thank you very much for joining, and to all the audience who managed to make it. We will be posting a recording on our website. That's at the link that's in the chat. If you want to keep track of what we're doing at the department, you can always follow us on Twitter. And I also want to invite you to our next event on privatisation, which has also received a lot of attention after water issues in the UK just recently. So, you know, watch this space for more. We've had a final question come in, which is about consultants, which is kind of an interesting one, because at our next event on privatisation, one of the main speakers has just written a book about consultants and the role they've played in privatisation, which you might be interested in, Bob. So I don't want to go over time, but we will be putting, well, we'll ask the speakers if they want to make their presentations available, but the videos will be online. So we should wrap this up now, and thanks again for everybody for coming.
Thank you.
Thanks very much.
Yeah, thanks very much.